Okay, I warmly welcome you to FCL Accountants Tuition Center YouTube channel. Luando Franklin is my name. I'm the pioneer of FCL Accountants Tuition Center, as well as a Chief Executive Officer. I have vast experience in training accountants. I've worked for several training institutions. One of them is the Accountants Training College under ZCCM, located in the Copper Belt in Chingola. In today's video, we are going to look at accounting for depreciation, and this topic is relevant to knowledge level ACCA, knowledge level CIMA, knowledge level Zika, and also knowledge level for those who are doing degree in accountants. In order to understand this topic well, you need to make sure you go to the first series and the second series and the third series, where we did the basic double entry, the common terms used in accounting, where we did the current assets and non-current assets that will give you a deeper understanding and a very firm connection to today's topic. In this video, we'll focus on the depreciation methods that are used, which are straight line method, reducing balance method. We'll also look at the non-current asset account and also the allowance for depreciation account. Therefore, we'll get started with the definition for depreciation. So depreciation is a systematic allocation of costs less scrap value for non-current assets spread over the useful life of the asset. That is very important. That is the meaning of the term depreciation. Therefore, depreciation complies with the matching concept. When you buy an asset that will be used in business for several years, at the end of each accounting period, there is a cost that has been incurred, and that cost must be matched with the revenue generated in the period. That cost is what we refer to as depreciation. So that is very important. Now, you need to understand that depreciation is calculated at the end of each year. Depreciation is calculated at the end of each year, and it will depend on the policy which the entity has adopted. Some entities would depreciate depreciation for each month of ownership. That is also known as on the pro rata basis. Some organization will provide for depreciation in full, regardless when the asset was acquired. That is very important. So now we look at methods of depreciation. So methods of depreciation. Methods of depreciation. This is very important. That's abbreviation. Methods of depreciation. We have one straight line method. Straight line method. The straight line method is also known as fixed installment method. or ECOP installment method. Then we have reducing balance method. Reducing the balance method. So the reducing balance method is also known as diminishing balance method. Now let's quickly look at the straight line method. Straight line method. Under straight line method, depending on the information given in the question, you can use percentage on cost. Percentage on cost of a non-current asset. Or you can use by formula. So we have two ways of calculating depreciation when using straight line method. Percentage on cost, if that is what is stated in the question, or by formula. You know the examiner wants you to use a formula when you are given the cost less scrap value. Scrap value could also mean residue value or salvage value. Divide by useful life. Useful life of the asset. So if you are given the useful life of the asset, you are given the cost, you are given the scrap value of the asset, then you can use the formula to calculate depreciation. So basically, those are the two methods under straight line method. Now we can go to reducing balance. The reducing balance method the examiner will mention it, or diminishing. So under this method, depreciation will be the cost less accumulated depreciation from previous years. Multiplied by the percentage. So that is how you calculate depreciation under reducing balance method. Now we are going to look at a question, which will be the first question here, which will be 27.1. 27.1, we have 27.1, we have a question there. The question is, a company starts in business on 1 January 20X5. You are to write up the van account and the provision for depreciation account for the year ended 31st December 20X5 from the information given below. Depreciation is at a rate of 25% per annum, using the basis that one complete month's ownership needs 1 month. So here the company is using depreciation for each month of ownership. And this is straight line method on cost, because that is the information that is available. So now we can first prepare the van account. The van account, that is the non-current asset account. So please ensure you refer to the series number 1 on the double entry concept so that you are able to understand the van account there. An account has 2 sides. So we have an asset was acquired on 1 January X5. So this is by bank. So we are told two vans, 6,900 pounds each. So multiply by 2, that will be 13,800. Then another one was bought within the same year on 1 August. X5 bank. The bank there is 72. So we have total there is 21. The total there we are balancing 21, the balance carried down 21,000. In the following year, it will be 1st January, X6. The balance brought down will be 21,000. So that is the van account. So make sure if you have insufficient knowledge on double entry concept, make sure you refer to series number 1, accounting for double entry concept and other concepts that was taught in that video. So now we go to, before you can prepare the allowance for depreciation account, you need to first calculate the depreciation. So the depreciation here, it is at the end of the 31st December, X5. So depreciation charge for the vehicles that were bought on 1 January 20 X5 were used for the complete year. So this will be 13,800 multiplied by 25%. This was full year, and this should be 3450. Then the vehicle that was acquired on 1 August 20 X5, this van was used for only 5 months. So the depreciation will be 7 multiplied by 5 upon 12 multiplied by 25%, because that's the method that they are using. And this will give us 750. Total depreciation for the year will be 4,200. Is that okay now? So now we can prepare the allowance for depreciation account. The allowance for depreciation account will be, maybe I can use this part of, can create some space there. Okay. So we have allowance for depreciation. Allowance for depreciation account. So at the end of the year, 31st December, X5, we have P&L. So the P&L there, it will be 42. P&L 42, that is the total depreciation that we have calculated here, 42. So at the end, we also have to balance this account. the balance carried down 4.2. And this balance in the following year, X6, the balance brought down, it will be 4.2. So we have done this question in full. I'm encouraging the viewers that make sure check for the first series, second series, and third series of this video. The first series is entitled Basic Accounting, Double Entry Concept, Common Terms Used in Accounting. The second series is on entering transactions in the cash book and posting to the ledger and the extraction of the trial balance. The third series is entitled Types of Errors, Correction of Errors, and Preparation of the Suspense Account. Those videos will give you deep insight so that you are able to understand. This is the fourth series. In the fifth series, we'll be looking at the disposal of non-current assets, profit or loss on disposal of non-current assets. So ensure you subscribe and hit the notification button so that every time when a new video is available, it will give you the notification. For today, we can end here. Thank you very much for watching this video. God bless you.